Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. Gosh, a lot of things going on. I'm sure you're kind of concerned about the markets up and down, concerned about tariffs. Well, I'm going to tell you today, or we're going to tell you today, why we're so excited about the tariffs. Good luck if you're trying to time the market. We're going to talk about that. We got some great facts, you know, because people get so emotional. We got some great facts to reveal to you that'll hopefully prevent you from timing the market. And, you know, we hear about the tariffs, we see all this, but you ever wonder, how does the United States collect those tariffs? Do they have somebody at the gate saying, give me your money? We'll explain that to you. And then China may look at other avenues to hurt the U.S. in this trade war. So a lot of great things to talk about. Chase, we got 4 companies. What are they? We're following today.
Yeah, 4 companies. It seems like a lot of things are on sale right now. So, you know, it's kind of funny for so long. We're like, I don't know. Things are kind of expensive. Doesn't look good. I feel like now we're actually starting to get some good buying opportunities in these stocks. So companies we're looking at today includes RH, used to be Restoration Hardware. Now they just go by RH. Also going to look at Caterpillar. And then, too, we're going to take a closer look at Harley-Davidson and Warner Brothers Discovery. And as always, we'll break down the fundamentals, look at the valuation ratios, the balance sheets, give you a good idea if we think it's a buy, sell, or hold based off the numbers we see here today.
And Jason, I want to point out, when we look at those companies, it is a live on-air research because we don't look at the numbers first and then pick it. We see, here's something in the news. Let's analyze it together with our viewers and our listeners to say, what does this really look like? So sometimes we're surprised as they are at the numbers. So it's right there. We're doing it right live.
Yep.
So, all right. Well, let's talk about why we're so excited about the tariffs. You know, and I've got to say, people, please just calm down. This has been going on for like 40 to 50 years, the problem we've gotten ourselves into with this trade deficit. And you just have to be a little more patient. And can we say, just wait 3, 4, maybe 5 months. You're going to see some major changes here. But gosh, this has been building for years. Don't expect to be done in a day, and expect the volatility we're having.
I'm going to say, you're like, can we wait 3, 4, 5 months? I don't think people can wait 3, 4, 5 days based off of the reaction that we're getting from people about, oh my gosh, the stock market's
3 or 4
crashing.
or 5 hours. Yeah.
And, you know, I don't want to, you know, make a situation that's difficult, you know, too light and, you know, too comedic by any means, but it is kind of comedy. Just seeing how people react to this, even before the tariffs went into place. I mean, we haven't even gotten to that point.
Yeah.
And people were freaking out about it. And as you said, I mean, 3, 4, 5 months, I mean, let's see kind of how it plays out. And these are, in my view, and we'll see how it plays out long term, I don't think we'll have tariffs on for even 3, 4, 5 years. I think you're right. I think it will be a negotiation tool, and we'll have to see what happens. But I think, again, that short-sightedness of people, it's dangerous. And we've seen over history, you know, the Empire of Rome. I mean, they were once a great empire, and they fell. We can't have that happen here with the United States.
And actually, you know, I do remember, and we talked about him last week. We'll bring up his name again, Peter Navarro. I think he called Wall Street a big bunch of babies. Like, just relax and calm down, I think he said. Is that the words? Remember that?
I didn't see his exact term, but I do know he was very bullish as well. He's buy stocks now because you're going to have deregulation, you're going to have tax cuts, you're going to have trade negotiations. It's all going to come through. And I think he said the Dow would be at 50,000 by the end of Trump's term. So we'll see what that looks like.
That's a possibility. I'm not going to say no to that. But do you want to talk about how we got in this situation? I mean, remember, in 2024, our national debt was at $35.5 trillion. In 1 year, 2024, it increased by $2.5 trillion. And this is what's been going on for about 40, 50 years, just building this debt. Well, if you look at that and project out, if we stayed on the current course, which for now would be comfortable, in 10 years, our debt would be about $60 trillion, unsustainable. We would end up like the Roman Empire back in 476 AD. So we got to change.
Yeah, and I take this with a grain of salt. I think we'll hit 60 trillion on debt.
What? You think so?
Not in the next 10 years, though. I think that's unhealthy, right? I mean, we look at inflation, and if we can grow GDP at a much faster rate,
right,
we could get to $60 trillion and have that be a sustainable level. But as you said, the current pace that we're on, that's what's unsustainable. Because then our debt to GDP, which I think is a much more important measure, because we always say a number means nothing at all unless you have something to compare it to. Just looking at the national debt as one factor, where we're at now is not super strong. But again, if we can grow GDP faster than we grow debt, maybe even reduce debt a little bit, I think we could see debt of 60 trillion maybe in 20, 30 years, and it wouldn't be problematic. I think you're right. 10 years old, we'd be running into some problems.
Yeah, because inflation will drive that higher. And the alternatives are, people, we'll just raise taxes on the rich. Well, that's going to hurt the economy.
Cut GDP growth.
Cut GDP growth. Also, too, cut expenses of the government spending. Well, that's going to hurt people as well. So what we're on is the only path that we can get out of this. And I agree 100%. If we grow the GDP more, you can handle more debt. Same way if you're employed, you make $100,000 a year, you got debt of, we'll say, $50,000. Well, if you grew your income to $200,000 and your debt went to $75,000, you're in a better position. Well, that's what we have to do for the government. The government has to get out of this somehow. And I do want to talk about with companies, because this is what we're going to see. We got to think about 75 countries now that are saying they're going to come to the table and negotiate. But there's companies bringing business here to the U.S., bringing plants to the U.S. And I was surprised when I saw this one, Siemens from Germany, because Germany said, we're not going to play. Yeah. But it's not the countries. It's the companies that say, hey, we have a profit. We got to make money. We're going to do what we have to grow our company. So it was Siemens from Germany, Taiwan Semiconductor. I think they said they're going to bring over like $100 billion, build factories here. Foxconn, there's others as well that they're starting to kind of line up to bring operations here is what they're looking at doing. And so keep in mind, it's the company that wants to benefit from it, even if the country is kind of saying we're not going to negotiate.
Yeah, as you said, there's two factors. The countries were looking pretty good too. Right now we're starting to get negotiations rolling. But as you said, there's so many companies that they may negotiate outside of their country. Because as you said, the U.S. is a huge consumption-based market. Yeah. You think, I'm going to pick on the automakers here, you think Porsche, BMW, Mercedes, they're just kind of standing by right now like, well, I guess we just won't sell in the U.S. anymore.
We're done.
That is not going to happen. They're going to try and find a way around this. And the other thing we look at with this influx of maybe new capital coming in, we talk about immigration. I think immigration is going to need some adjustments to it as well because, frankly, I don't think we have the people, the personnel to fulfill these jobs. These companies might start bringing employees with them. And I'd say that's a pretty good way to vet good immigrants into this country if they're coming with a qualified company there.
Oh, yeah. Think how much that can benefit because you're bringing a person in with not just a job already, but a good paying job. And when they get here, they're going to be saying, well, I got to have housing, either rent or buy. I got to go to the grocery store, got to get my hair cut. I'm going to go to the movies. I'm going to go to the restaurant. All these things are going to add to this great economy we have already, as opposed to the trouble we've had with immigration in the past, where these people come in and have been dependent on the government to get going. And some of them are great people coming in, but for our economy to grow, this is going to be a very big thing. And I think we'll see more of that go on where companies say, yes, we want, because we don't have enough people here. Yeah. We've talked about that before. So it's got to come from automation and people coming in, immigration that are good people that have a job already with these companies. It's going to be a boom.
Yeah, inflation rate still, or not inflation, unemployment rate still around 4%. We just don't have the people to fulfill that. So, I think there's a lot of positives that are percolating, even though people are like, oh, what are you talking about positives? And we've gotten some pushback. You don't know what you're talking about. Look at the stock market. It's a short-term thing, and we've talked about for months now how overvalued the stock market was, and the stock market doesn't like uncertainty. No. Don't get me wrong, this is causing uncertainty, but the big thing is we're long-term investors, and I think we look at 2-3 years from now, I'm really, really not concerned.
Oh, yeah. I'm very optimistic in the United States going forward, long-term and short-term. I think, again, by the end of the year, we'll see a whole different picture. But let's talk about something that is a concern for investors, and we talk about good luck if you're trying to time the market, and not just now, but any time in the past. It's always proven to be a big mistake. And you pulled up these numbers. I was surprised to see them. But going back over the last 20 years, 7 of the 10 days in stocks came within, 7 of the top 10 days in stocks came within a 2-week period, 14 days later of the worst 10 days. What does that tell you? Don't time.
Yeah, don't time. There's volatility. And I mean, the problem is those people that panic, they sell during the worst days. Obviously, they're missing the 7 of the top 10 best days. And then also too many times they miss the eventual recovery. They might miss, that 7th best day, let's say. But the big problem is they're out and they're missing that upswing. And we hear it all the time. Oh, I'm going to get out and I'm going to wait until things feel better. Well, when things feel better, it's too late. You've already now missed out. And the big thing that I point out to people is if you look at the average recovery from a bear market, it's about 2 years. Now, again, not anything exciting to go through. It kind of sucks to have dead money for 2 years. Don't get me wrong. And we did hit bear market territory here. But the big issue is, let's say you sell out after being down 20%. I said it takes about 2 years on average. Well, you go to cash. Now you're talking about an 8, 9, 10-year period if you're getting 2% even on the money to get back to where you were. And that's where you talk to people. It's like, oh, it took me 10 years to get back to where I was from the financial crisis. Well, what'd you do? Oh, I sold. Why'd you do that? I mean, it's insane. And you can't time these. And, obviously we've seen just a lot of volatility this week, but a great example of how quickly things can turn was, what was it, Wednesday? I mean, the S&P 500 was up 9%, more than 9%. It was the third largest gain in a single day since World War II. Then the Dow also saw its biggest percentage gain since March 2020. And the NASDAQ actually had its biggest one-day gain since January 2001, and it was the second best day on record. Now, again, we're not advocates of investing in the S&P 500 or the NASDAQ in particular. I mean, I wouldn't invest in the Dow. I think it's my favorite of the 3 indices at this time. But the point is, you can't time the short term.
Right.
And we saw how quickly things can move.
And what's happening, and the reason why this happened was the announcement, and it came out of left field, that there will be a 90-day pause on the full effect of tariffs on companies that are negotiating, which left China out, and China actually got more. They added more, we added more. I forget who's ahead here adding more to the tariffs. But the big announcement that, okay, we're going to put a reprieve on this because you're talking to us, which I think makes perfect sense when you're negotiating, because it's, okay, you want to talk, we'll cool off on things. And what I want people to realize, that doesn't mean, okay, smooth sailing from here. No. I mean, there's going to be negotiations that go well. Some won't go well, and they'll have to walk away from the table. Then they'll come back. And again, 75 countries, there's a lot more to do yet. So don't think that this game is over, but don't jump ship yet either. Yeah,
and I think this is the issue with trying to time things. I don't know when these are going to start coming to fruition, but I saw Kevin Hassett, who's actually the National Economic Council director. He said they've already got offers on the table for more than 15 countries. They also said they have countries, 20 countries, closing on 20 of them, actively beginning negotiations. 75 countries have contacted the U.S., 20 essentially have already started the negotiation process, and 15 have trade deals on the table.
So is that a total of 35, or is that...
No, because 20 have started, 15 have already kind of formalized offers.
Those 20, 15 have started. Okay.
Yeah.
Okay.
So, I mean, the point being here is maybe next week you start getting new trade deals coming into play, and I don't know what those offers look like. They might be terrible offers, so they might not come to fruition. This is where you can't time things. But let's say they are good offers. Now, all of a sudden, you clear something with Vietnam. You clear something with Taiwan. That starts to remove uncertainty from the market. I think you'll start to get stocks climbing on that news. Now, on the other front, you're starting to get earnings reports. Companies might start coming out saying, like, we don't know what's going to happen. And, oh, my gosh, we're going to pull our guidance. That might push stocks lower. The whole premise here, I want our viewers and listeners to understand, don't try and time this. I mean, we read so much. We understand so much going on. I don't know what the heck is going to happen next week on Monday, Tuesday, Wednesday. I mean, it could be up, could be down. You're going to play this game, and you're going to cost yourself money in the long term.
And we haven't seen the details yet, but we know on Friday that the big banks should report earnings, and they were actually pretty good. The problem being, and I know J.P. Morgan, I think, went up quite a bit, but the problem being is like, all right, so we did good this past quarter, which is good for businesses as well, but going forward the next 3 months, again, they're unsure. They're not sure what's going to go on. So, and I want to ask you, too, you had something on here about the water clause, and I know we talked about that. I think you know better than I do. Explain what the water clause is.
Yeah, I mean, I thought this was interesting as well. It removes a layer of uncertainty, in my opinion, because what they're doing is they actually put this on the water clause for cargo entering U.S. ports. This means that any cargo loaded onto a vessel at the port of loading and in transit on the final mode of transport on or after 12:01 a.m. on April 5th, 2025, and before 12:01 a.m. on April 9th, 2025. And number two, this must also be met, is entered for consumption or withdrawn from warehouse for consumption before 12:01 on May 27th, are subject to the 10% additional rate in lieu of the country-specific rate of duty, which again in China is 145%. So if somebody, let's say, purchase something from China on, we'll call it April 1st, that's not going to be here by the time that the tariffs started on China. So what they're saying is, well, it's already in transit. We're going to give you grace on that as long as it's sold before May 27th. So what that does, it removes one layer of uncertainty, in my opinion, which I think was a nice thing to hear for especially many of these retailers.
And if you said you couldn't really follow that, you're not sure what Chase was saying, because it is complicated. Yeah. This is why we do the newsletter. This is in the newsletter. So sign up for the newsletter. You can do this and promote it. But the newsletter, smartinvesting2000.com, sign up for it there. You can actually read it to really understand it, because that's what we're trying to do, is educate people on this.
Yeah, and I know we got a lot to get to here, but I did not want to forget this. I saw this great quote from Charlie Munger this last week. And late Charlie Munger, great value investor, partners with Warren Buffett for many, many years. But he was quoted saying, if you're not willing to keep your chin up during the occasional rout, he continued, you're not fit to be a common shareholder, and you deserve the mediocre result you're going to get compared to the people who can be more philosophical about these market fluctuations. I also love that he shared at one point in time, he was discussing with an interviewer that his position in Berkshire Hathaway had declined by more than 50%. And they're like, are you worried about this? He said, zero worries. This is the third time that Warren and I have seen our holdings in Berkshire Hathaway go down top tick to bottom tick by 50%.
The third time.
Yeah. And this is why, again, people worry about volatility, and the ones that sell are the ones that lose. And you're like, I just can't be in stocks with the volatility. Okay, after 10 years, I can't guarantee. I'm very confident. That somebody else that invests in good quality stocks will have way more money than you. And that is on you. That is your fault for not being able to, again, weather volatility over a short-term period.
And he brings up some good points. And the big mistake that people make is they say, well, I'm down 10%. At this rate, I'll be gone, of all my money be gone in a year. No, it's based on the value of those investments you made. Don't think just because it did this over the last 10 days, it'll do that same thing over the next 90 days. So again, great points from Charlie Munger. Let's talk about the tariffs and how, because you wonder, like, okay, all this money coming in, how's it coming in? Is there's somebody at the port saying, okay, write us a check? No. The U.S. doesn't even do the calculations for every shipment that comes into the country. No matter how it comes in, could come in by truck, plane, ships, car, whatever it may come in as. The country doing the importing, they're the ones that do the calculation and also disclose what they have. Now, sometimes these countries will have what's called custom brokers, who they pay these custom brokers to do all the work for them, but they calculate what the cost of the tariff is, and then also, too, what is coming into the country.
Yeah, and I thought it was kind of interesting. I didn't know this. I thought it was maybe more formalized, but it's kind of on the honor system. I mean, before a shipment approaches the border, the importer or the customs broker files electronically the paperwork, and it says what they are bringing and how much they owe. When the ship pulls into port, the information is reviewed by customs agents before they allow the goods to be unloaded and released.
Yeah, and it is kind of like on the honor system, which I was kind of surprised on, but so is our tax system.
Yeah.
I mean, no one audits every single tax return that comes in. Now, you do get audited, and the more things you do, the higher the income, your chances of audit will probably
the more you try and skirt things.
Yeah, right, exactly. So, but they will be audited. Customs do, perform the random inspections to verify, yes, you said you're bringing these widgets. Yep, that's what's actually there. And what's being brought up too is that the correct amount that you're paying the tariffs on. So they do these audits. I did try to find how often. They didn't really disclose that. I don't think they want to disclose that. But I'm sure it's probably about as much as they audit your tax return. It's probably an amount depending on, and I'm sure a country like China bringing big billions is going to be more than a little country, little island bringing in millions, So that's where they're going to handle that.
Yeah, and then also, too, the way it works is importers have an account with customs and pay the duties to them. If they use a licensed, again, customs broker, then that broker would make the payment. After all this is completed, whoever imported the goods has 10 days to pay the duties. I mean, it's important you pay it within that time period, to say the least.
Well, and that's what I was going to say, is that if you don't pay it in 10 days, and again, it is an honor system, But if you don't pay it in 10 days, what then happens, you're going to hit with admin fees, you're going to hit with interest, other penalties that they can create for anything they want to come up with. And I think the biggest concern is, you know what, we're your biggest customer. You can't come to us anymore. So there's a big incentive not to be screwing around with those numbers, not to be screwing around, because if you get caught, you're going to be paying interest, penalties, and worse, you may not be able to import any more of your goods here to the United States.
Yeah, and I think it's just kind of important to look at how these tariffs are collected, because I think most people, again, are complaining about tariffs, but they don't know what a tariff is. They don't know how it's collected. So, I mean, at least gives you a little bit more information about what a tariff is and why it's used and, again, how it is collected.
Yeah. And the tariffs, they've been around for a long time, since George Washington and President Lincoln, and they loved them. They said these are great. So they've been around for, what's that, 300 years, 250 years? How long have they been around?
1776, so not quite 300 years, but...
About 250, I guess. Yeah. Well, let's talk about China. May look at other avenues to hurt the U.S. in this trade war, because they're playing hardball here. The tariffs on Chinese goods hurts them more than the tariffs that we put on the goods going to them. And let's do some simple math here. The U.S. exported $143.5 billion of goods to China in 2024. Now, what did China give us? What did they import to us? $438.9 billion, about 3 times the amount. So who's going to be more in a difficult situation? The guy that's importing less or the guy that's importing more? Easy answer there.
Yeah, and then the thing is, they keep increasing the tariffs on our goods. Obviously, we were increasing the tariffs on their goods, and it's this back and forth. But as you said, I mean, they're the ones that will be hurt more than will be hurt by this. And don't get me wrong, people have commented like, "Oh, but tariffs, they hurt us." Well, yeah, I mean, obviously, it's not a win essentially in the short term. And this is one thing we keep talking. There's short term pain, but I think it's for a long term purpose, and especially with this relationship with China. And the point here is that it hurts them more than it hurts us. Keywords still hurts us. But the reason it also hurts China is they are an export-driven economy. China exported a total of roughly $3.58 trillion worth of goods, so we did account for, again, more than 10% of those goods, while importing just $2.59 trillion worth of goods for a surplus around $1 trillion. This makes a huge part of GDP, as net exports contribute around 20% of China's GDP. Just to let you know, in the U.S., GDP actually looks at these exports as a negative because we import more than we export, so it subtracts from our total GDP. China, it grows their GDP, so this is a huge problem for them, in my opinion.
Yep. And these are all numbers and facts to make you understand or help you understand why this is going to be okay. I was surprised too. No, not surprised. I'm lying. China did issue a warning alert to its citizens of the potential risk of traveling to the U.S. and attending schools here in the U.S. Although there were approximately 1.6 million Chinese tourists that visited the U.S. in 2024, and we have about 250,000 students that are enrolled in schools here, it's not going to be a major problem. We don't see it because when you consider that there's an estimated 77.7 million people from other countries visit the U.S., okay, so we're going to be down, what is that, 2%?
Yeah, and I mean, this is the problem with the news, and I'll kind of get to this as well, is they use big numbers, and they use the absolute numbers rather than, I'm going to call the relative numbers. Yeah. It's like, wow, 1.6 million people, oh my gosh, that would really hurt our economy if we're not getting that amount of tourists in the country. It's like, well, actually, I mean, we go from 77.7 million down to, 76.1 million. That's still pretty good. You know?
But see, that doesn't sell commercials, so that's a problem.
No, it doesn't. I mean, kind of speaking to that point, I was shocked by this. I mean, I say shocked. I kind of jumping on your bandwagon here, but I was surprised by the fact that there's an article this past week that said China could crush our housing market by selling mortgage-backed securities, and people have this concern around China about them dumping our debt and creating chaos. But the reality is, it's not the same problem that it was, I'd say, 5-10 years ago. If we look at mortgage-backed securities in particular, foreign countries only owned around 15%. It's like, that does sound pretty high, right? But that's not just China. That's all foreign countries. Top owners, they also included Japan, Taiwan, and Canada. Frankly, I don't see those other countries dumping them to try and fight back against us. I think that'd be a big mistake. China is the only one that I think would have the goal to go ahead and do that.
Right. And actually, it does appear that China holds just about 2 to 3% of these mortgages-backed securities. And again, they've been selling it over time, holding about down from 8.7% a year ago, year over year, month of September, and down 20% since the start of December. So it's not like this just happened last week, last month. It's been ongoing. And it makes sense what they've been doing. Maybe they were preparing for this themselves as well. But it's not really hurt the mortgage market. I mean, your mortgages are still about the same.
They did increase. I'm going to say they have increased lately. I mean, you've seen the 10-year and the mortgage-backed security.
Right.
Well, no, mortgage 30-year jumped over 7% on Friday. So I mean,
what did?
The 30-year.
Oh, I thought you said
the 30-year
10-year.
mortgage. The 30-year fixed
30-year
mortgage.
Okay, right.
Jumped over 7%.
Right.
And I mean, don't get me wrong, it's not good. And if China's sold, again, I want to be very clear. This is not like, oh, Chase is saying it's positive China sells mortgage-backed securities, but it wouldn't be catastrophic. I mean, maybe, I'm going to say mortgage rates around 7%. Maybe they go back up to 8%. I'm not sure. But it wouldn't be like, oh my gosh, mortgage rates went up to 15% because China dumped all of our mortgage-backed securities and it created all this chaos. Again, it wouldn't be a good thing, but it wouldn't be a detrimental to our economy fact to the equation.
And people have to realize this is not like back in the 90s. I believe back in the 90s, China did hold, I want to say about a third of our debt. Our debt is mostly held now by U.S. citizens.
Yeah, and actually I did want to bring up here as well, we talk about mortgage-backed securities, but even Treasury securities, China owned just $760.8 billion. Again, a large absolute number, but that's about 2.2% of the total U.S. federal debt, which is now, again, around 36 trillion as of January. So it's not as big of a problem, as you said, as it used to be. And I think China, if they did dump, let's say they did dump it too. Well, now that concern is gone. What are they going to do next?
Yeah, it's like, okay, you shot that little tiny bullet because it didn't really hurt that much. And it would hurt a little bit, but it'd be over. So they don't have a lot to deal with. And again, we're their biggest, and they won't know. United States is their biggest customer. So that they've got their issues to deal with. But all this information does come from our newsletter. Also in the newsletter this past week, you'll see even a little screw is getting hit with tariffs. Gold is currently a hot commodity, but gosh, it's pulled back somewhat. This is not a good time to buy a Mercedes. That changes from day to day with the tariffs. Give the tariffs some time. We keep talking about that. Be patient. And with all the noise, an important inflation report seems to have gone unnoticed. I guess we're not going to get time to talk about that inflation report, but that was a good report. Real quick, about a comment on it?
Yeah, I mean, inflation came in, I think, the lowest since March 2021 when the core CPI was 1.6%. We're not going to see that for a while. But again, inflation is coming down. Might pop back up with the tariffs, but we'll see.
All right, coming up, we got company RH, Caterpillar, Harley Davidson, and then Warner Brothers Discovery. Stay with us. We'll be back after this short break. Alrighty, welcome back to the second half of the Smart Investing Show. This is where we go over 4 companies, analyze right alongside you what these companies are. Could be buys, could be sells, could be holds. Talking about RH, Caterpillar, Harley Davidson, Warner Brothers Discovery. Chase, let's jump right in here to RH, which used to be Restoration Hardware. I wonder why they changed the name. Why?
I don't know either. Because I think... Actually, no, I don't know. If you go to like UTC Mall, I think it just says RH now. Yeah. But I think most people still refer to it as Restoration Hardware. So I don't know.
And they sell furniture, right?
Furniture, I mean, fixtures. I mean, it's definitely upper end, like very, very high quality, nice stuff there.
And maybe it's because when I think of Restoration Hardware, I think of a hardware store, screws, nuts, bolts, hammers. Maybe that's why they did. I don't know.
Maybe.
So, well, let's get into it here because it could be a good buy here. Again, symbol is RH for RH. They're in the specialty retail industry. Not a good start, maybe. The short is 22.6%. So a lot of people, a lot of investors thinking this is going to plummet. They have about 89% is institutional owned. They do not have a good PE ratio, which means you're paying a lot for the past earnings. It's 45.6, more than double the industry at 21.4. Price to sales does look okay, 1 versus 0.8. There is no price to book value. It means you take away all the the liabilities, even the intangibles. There's nothing to this company at all. So that's not a good start there either. Price to cash flow, very expensive, 191 versus 10.4. I will say they do have a good PEG ratio, which tells what you're paying for future growth. It's only 0.8 versus 2.5, so that is a positive. This company has been struggling over the last year. Their earnings were down 38.7%. The industry was up 22.8%, so big reversal there on their part. Sales did do better. Those sales climbed by 5%. The industry was up 3.2%. Now, the analysts going forward on the earnings, they do like this. They give it a 5-year earnings per share growth rate estimate of 24.8%, well above the industry of 4.3%. Unfortunately, they do not pay a dividend. Take a look at the balance sheet. Current ratio 1.4, same as the industry, so they got some good liquidity there. Debt to equity, there's nothing there. You'd have to look at the debt to actually see because they have no equity, so they can't compare the debt to equity when there's nothing there. Net profit margin 2.3. That's about half the industry at 4.1. Return on equity is a negative 44.3. That's not good. I'm not feeling comfortable here unless you got something good. Tell me going forward.
I mean, maybe not. We'll see. I'll get to the numbers here. But the big thing is we'll start with the current price: $164.62. 52-week range: the low $123.03 and the high, wow, $457.26. Year to date, the stock is down over 58%. I mean, still over the last 5 years, not bad, up 28% considering it's down 15 to start the year. And the 10-year return, you're still up about 92%. But the crazy thing is, last week, the company reported earnings. I mean, I don't think they were that bad, to be honest with you. I mean, the earnings came in at $1.58. Analysts were looking at $1.92. So, I mean, obviously they missed. And revenue was
$1.58.
$1.58 was what they made. $1.92 is what they were expecting.
That's a big miss.
A 40% decline because of that, though. I mean, that to me is a little excessive. I mean, I've seen misses like that. Maybe, I mean, 40. I don't even know how many times I've seen a stock plummet 40% in a day. But the crazy thing is that I loved this. I thought it was so funny with the CEO on the conference call. He's like looking at it and he's talking and he's like, yeah, I don't even know where the stock is right. And he's like, what? And he looks it up and he's like, oh, SHIT, you know, it's like, okay, I just looked at the screen. I hadn't looked at it. It's like, yeah, it looks like it got hit when the tariffs came out and everybody can see our 10K where we're sourcing from. So it's not a secret. We're not trying to disguise it by putting everything in an Asia bucket. But I mean, it's like they got double whammied with the tariffs and then also their earnings. And I mean, I frankly, I looked at their situation. I don't think it's that bad. And I think there might be some opportunity here. I'll get to the valuations in a second. About 72% of RH's products came from Asia, 35% in particular from Vietnam, and 23% from China. So at least most of what's coming from Asia is not China.
Right.
I think that would be a very, very hard thing for RH to overcome. They might be able to shift some out of China. And I still believe if you start getting things into Vietnam, Taiwan, I think those are going to be countries that we get deals with earlier on. It might be a situation where RH could get out of this, not unscathed, but with very limited issues. And I think this is interesting because, I mean, you look at the estimated earnings for this company. I mean, the growth is just phenomenal. For 2026, they're looking at earnings growth of about 90%. For 2027, they're looking at earnings growth again of about 45%. And that's with 20 analysts. It would take us to an estimated earnings per share of $14.91. It gives us a target sell of $247.51. So the stock trades at about 11.5 times those future earnings.
I did look at the balance sheet to find out the debt because no debt to equity. They do have a fair amount of debt. They got about $3.8 billion in debt. Now, 2-3 years ago, it was still about the same, about $3.6 billion. So they've carried this debt on a regular basis. I like the numbers you give going forward. Seems to be some potential there. But I want to also know, big factor, when does this debt come due? Because if it comes due in the next year or two and they were paying 2% on the debt, now they're going to pay 4, 5, 6, 8%. That's a problem. That's a lot of debt in the balance sheet and only about $80 million in cash. So not a good position, a financial position, kind of a weak balance sheet. Yeah,
that would scare me out of it. Otherwise, I'd be intrigued by this company, but with the weak balance sheet, I think there's other plays in the sector. And I'll tell you that this housing situation, I think, is very, very interesting. And the CEO from RH did point out, that we're essentially in the worst housing market in almost 50 years. He talked about that there were 4.09 million existing homes sold in the U.S. in 1978. That was when the country had a population of 223 million. In 2024, the population shot up to 341 million, but just 4.06 million homes were sold. So we sold less homes with more than 100 million more people. I mean, that is a very interesting dynamic. And I really think there's so many housing stocks that have been pressured that I'll tell you, we have a couple in our portfolio. I think those are going to be big winners here over the next 3, 4, 5 years as I think this housing situation normalizes.
Yeah, and I looked at the range of the estimates there, and low at $9.47, high at $18.80, $18.30. That's a little bit high. That kind of worries me.
Yeah, I mean, that's a big concern. And I would say the big concern with this company is, again, that balance sheet. I would tell you this would be a non-negotiable, and, you know, the valuations could be great for RH. We could get even a target sell price with a 300% estimated return, but with the balance sheet that weak, it's a no-go for us.
Yeah, and I did see 90 days ago, 1880 was the estimate. Now, we'll just say 1491 or something. So
I'm not surprised by that with tariffs, though. I mean,
yeah.
I think that, frankly, I think that estimate will keep coming down, but you got a little bit of a buffer here.
Yeah, so it's I mean, you look at that big drop, like, oh, this should be a buy, but I don't feel comfortable with it. What do you think?
I've said I would never buy this because of the balance sheet. You could have a great estimated return, but a weak balance sheet, that is a automatic disqualification from our research process.
And I bring that up because it's such an important part. When we invest in a business, we want a strong balance sheet because we know, kind of like Charlie Munger says, you're going to have these bad periods. And if you go through these bad periods with a company with a weak balance sheet, you have a chance you're going to lose a lot of money, maybe. Be like a Weight Watchers where they went from, I think, 92, I think we're talking about that next week, $92 a share. You know where they're at now? 19 cents.
Oh, I was going to say 8. 19 cents. Yikes.
They lost more weight than Oprah did. So, well, maybe we'll talk more about that next week. But let's move on here because I do want to talk about Caterpillar, which has been around for, gosh, Caterpillar is a very old company. They've been around for a long time, and you know, they've had their good times, and they used to do a lot in China. They pulled back on a lot of their China work there. But Caterpillar, they're saying, I really love this.
Was that by choice?
I don't know. They're a symbol. I've always loved that CAT, C-A-T. Farm and heavy construction machinery is what they're in. Not much short on the float here, 2%. Only 72.5% institutional owned. I say that because that means about 28% of individuals hold this, which is pretty high for a company of this size. Look at the PE ratio. It's a 13.3 versus 10.3. That's fine. Price of sales, 2.2 versus 1.1. Price to book value, 10.1 versus 9.8. That's okay. Price of cash flow, 11.9 versus 11.5. And the PEG ratio, 1.3 versus 4.4. So nothing too good or too bad here on the valuations of this company. The earnings were down 0.4% over the last year, but that was better than the industry decline of 4%. And their sales were down 3.3%, also better than the industry. That was down 10.5. The analysts give it a 5-year earnings per share growth rate estimate of 11.7% versus 8.5%, so that's a big positive. I'd like a company that pays a dividend, and Caterpillar pays a decent dividend. It's about 1.9%, but only uses about 25% earnings to pay that out. We do see on the balance sheet, current ratio 1.4, industry is 1.8, but I'm okay with that. Could be a problem here. Debt to equity is 2 versus 1.5. So I'm wondering if they have low equity or just have a lot of debt. I'll try to check that balance sheet.
Financing.
Oh, that's right. Financing.
Yeah. Caterpillar is one where I not waive, but you look at the balance sheet a little bit differently because they have operational debt and they have financing debt. Distorts the ratio. I mean, I know there's Caterpillar, like Ford, General Motors. There's some companies where that debt to equity can be skewed. Caterpillar is one that I actually know that their balance sheet is actually quite strong, even with that debt to equity looking questionable.
And this is what we talk about, understanding the numbers, because I know we've done that, as I said, with General Motors, with Ford, all these other, because they do the financing for the vehicles. Makes perfect sense that when they sell a big tractor for, I don't know, they go $2-3 million. I mean, they're going to finance it for the person, or probably have a leasing on it as well. So that does make sense. So thanks for bringing that up. Net profit margin, very good though, 16.7. That's double the industry at 8.4. Return on equity also phenomenal, 55.4 versus 30.1 for the industry. Return on invested capital, 18.8 versus 12.9. I'm like when I say they had free cash flow, $8.8 billion. The industry was at $3.4 billion. So they generate some nice cash flow, which we like to see.
Yeah, love to see that. And I mean, we know the name Caterpillar is a very well recognized, and I think it's a well respected company as well. I don't know. Ooh, I hate Caterpillar. I don't ever really hear that very often.
I'm sure there's somebody, but I've never heard it myself.
Well, looking at the current price for Caterpillar, again, their ticker symbol easy CAT, C-A-T, $293.45, 52-week range. The low here, $267.30, and the high is $418.50. Year to date, the stock has pulled back. I mean, obviously, like a lot of other things, down close to 20%. Going forward, though, we go out to December 2026. I see estimated earnings per share here of $21.76. It gives us a target sell price of $361.22. Now, it's not quite at a 30% margin of safety. It is only about at 23.6%, 23.1% gain actually from the current level. But this is one thing that I find very interesting with these tariff situations, that in the market panic, I think you might be able to start picking up very strong companies at good prices. I mean, Caterpillar, before it was overpriced. We couldn't buy it because of the valuation situation. Now, I mean, you might be able to buy a Caterpillar and it still fits in with our value philosophy.
Well, and they've probably had some comeback, like from when it was at Thursday, the beginning and so forth. And perhaps when you looked at it maybe on Monday, Tuesday, it could be in the buy categories. So that's something you want to look at. I
mean, the low again was 267.30. That would have given us at least that 30%. So it did register. And I mean, you might see a little bit of a downdrift in those earnings estimates, but I think it's definitely worth watching.
If we're going to talk about putting this in our portfolio, one thing I'd want to know is how is their construction, where they sell the product? Because I think we'll have a boom here in the U.S., but some other countries may not. So you'd really want to understand, if you're going to invest in Caterpillar, where is their business at? How much is in the U.S.?
Yeah, and I think I take the opposite side of the coin here. UBS actually downgraded them, saying that a trade war from President Trump's tariffs could bring about machinery demand destruction due to higher prices. I think that's a short-term concern. Yeah. And again, I want to be clear. I don't think we're going to produce all iPhones here in the United States. But again, you even bring back a little bit of production. And that's just Apple. I mean, other companies, you talked earlier in the show about, Siemens, Taiwan Semiconductor. You think they're not using Caterpillar at all to build those huge factories, and in particular those chip plants? I mean, I think there could be a nice opportunity here for Caterpillar over the next 2, 3, 4, 5 years if companies do start bringing back those jobs, those factories.
And I agree with that, because we always look at buying a business in the next 3 to 5 years. I think it's great. I hate when some of these analysts come out with the short-term movements, like it sounds like it's bad. And we always talk about, we could buy a company today, we can buy it at 100. Next week, next month, it's at 85 or 90. We don't care, because we look at the business, and I think this is a great business going forward.
I take the opposite side of the coin there as well.
Again, that's twice in a row.
I love when analysts come out and say,
I know what you're going to say. Okay,
they say, we have short-term concerns over no exciting catalyst, but long-term, the business looks okay. It's like, okay, that'll pressure the stock in the short term. Then we as long-term investors can step in and buy it. And, we just did a big buy here this past week. We might look at doing another buy here in May and June. And who knows, maybe Caterpillar might find its way into our portfolio as well.
And I remember years ago, probably back in the 90s, I read this book by David Dreaman about going away from the crowd. And that's exactly what you're talking about. You follow the crowd, you're not going to do well. But you go against the crowd, you're going to get some great values when these people come out like, short term is going to do terrible, the stock drops. Oh, well, we're long-term holders. We want to buy it. Okay, great. Thank you for putting it on sale.
Yeah, nice little discount. Thank you.
Yeah, I know. So it's how you look at things. And again, we talk about, trading never really works that well. So that's okay. This next company, I mean, this has been I would put in the same category as Caterpillar. I'm talking about Harley-Davidson, because this is a well-known company in the United States. Has been around for years, but I believe, and we'll talk more about this, I believe their market is changing, and unfortunately not for the good. And they've had some difficulties here. So the question is it time to buy or sell? Let's go over the numbers. Talking about Harley-Davidson, their symbol, HOG, HOG. Did you know that? Because that was I think for younger people, I don't think you even know that name, HOG. That's what you should call the Harley-Davidsons. Okay, yeah.
Yeah, I knew that.
Maybe I told you. I don't know.
I remember there was Wild Hogs was the name of the movie with John Travolta, and they went on a road trip. And I remember that was when I was a kid. That's how I knew the term hog.
Do you have any friends that drive a Harley-Davidson?
I do not.
Yeah,
I have a few friends that have what are they called, the crotch rockets, the little Japanese and the speed bikes, the street bikes, yeah. But actually, those friends have now become dads and got rid of them. So I don't know if I have any friends that have motorcycles.
Yeah, I know a couple,
Yeah.
and they do have Harley Davidsons, but they're my age, and that's the problem. So we'll talk more about that as we go on. Let's talk about Harley Davidson. They're in the recreational vehicle industry. Big short here, 11.7%. We don't like it much above 2 or 4%. 98% institutional owned, which does surprise me. Now, you got to be careful of this. Could be a value trap because the PE ratio is 6.6 versus 44.9. Price to sales, 0.6, about the same as the industry at 0.5. Price to tangible book value, 0.9 versus 7.2. That means for the tangible assets, you're paying 90 cents on the dollar. It's a pretty good buy when you look at that by itself. Price to cash flow, 2.8 versus 6.6, and no PEG ratio. So no one wants to predict what's going to go forward here. We do see earnings over the last year, down 24.4%, but not as bad as the industry, down 45.3%. That does surprise me over the past year. Sales also fell 10.2%. Industry's down even worse, 16.4%. Going forward for 5 years, the earnings per share growth estimate for the analyst is a negative 11.9. Here, the industry does say it's positive 13.4, so that's not a good thing for Harley Davidson. They do pay a nice dividend of 3.2%, and this is good. They only use 20% of their earnings to pay that out. And then let's take a look at the balance sheet here. Current ratio 1.4 versus 1.8. That's good. Debt to equity 2.2. Now, again, that doesn't look good, but I'm sure, as we just talked about with Caterpillar, same thing financing.
One of the first headlines I see here, Harley Davidson evaluating sale of financing unit.
There we go. Now, what will they sell it on? 80 cents on the dollar? I don't know. Yeah, we'll see. That's, again, if you own this company, looking buying it, you're going to want to know those answers. We do see also to the net profit margin is very good, 8.8 versus 2.7. Return on equity 14.4 versus 7.4, and return on invested capital 4.7 versus 5.3. So nothing too exciting. I'm very curious what you have going forward.
Yeah, so current price here for Harley Davidson, again, ticker symbol HOG, $22.54 is what I wanted to say there. 52-week low is $20.45 and the high $40.51. I see year-to-date stock down about 25%, but the interesting thing is over the last 10 years, the stock is down 64.5%. So it's been a rough ride if you've held HOG during that time period.
Was that a pun, a rough ride on the...
A little bit, yeah.
Okay.
Going forward, though, you got to December 2026, the estimated earnings per share. I mean, this looks intriguing. $4.02 gives you a target sell price of $66.73. So, I mean, it looks good, but the big question mark is, do you have a value trap? And again, a value trap is something where the valuations look strong, but the values are low, or the valuations are low because essentially it's a declining industry.
Yeah.
And the interesting thing with Harley Davidson is, as we talked about, they are in a very precarious situation where they have an older demographic. Are they now going to try and market to younger bike riders, motorcycle riders? But that could then risk their initial demographic. Yeah. So, I mean, they're in a very difficult spot where they need to attract new buyers, but not alienate their base and their normal customer base as well. So, I don't know. I have big concerns about this one. I don't know if I'd touch it just because of those reservations around a growth strategy for Harley Davidson. And it was interesting as well. There was a board member, Jared Durdeville, I think is how you say his name. He resigned, and he wrote in a letter that he had grave concerns about the current state of Harley Davidson and its leadership. That's generally not good when you get a board member stepping back and saying negative things about that, because he probably held Harley Davidson stock, I'd assume.
Yeah, you want to check his portfolio, but I can't remember the last time I heard a board director resigning with that type of say there. But the problem is, and I think it was because I made money off of Harley Davidson before years ago. It's a great business, did very well. But I know they tried to change their model before because they knew that and I'm their demographic. But the problem is, to be very frank, their bikes are pretty heavy. Yeah. And guys now in their 50s and 60s, they say, if that bike goes down, I got to call somebody to help me get it up because I can't do it myself. That's their dying demographics. And they just say, okay. And also, too, motorcycles, pretty dangerous. And people are like, I don't bounce back the way it used to. So
Motorcycle accident, that hurts you when you're 60 years old.
oh, yeah, you may not make it. But the younger generation, I don't think they want those big bikes. They're not part of that. I mean, it was a great movie, as you said, but it didn't make you want to go out and buy a new, Harley Davidson. So I hate to say it, this is an icon for the United States for years. I think it's over, and I would love to know how much they have built in China, or I think they used to be mostly United States, but that doesn't seem to be helping them. They get a problem.
Yeah, I'd say valuations are good, but again, I think they're good for a reason.
Yeah. So I would have to say avoid it, and I hate to say that because I love American businesses, but they'd have to do something major. And I also wonder, too, if the whole situation with motorcycles are declining overall.
Maybe. I mean, like I said, I don't have many friends that ride motorcycles. So
Yeah.
I think I have 2 or 3 that have their license, but they don't actively ride.
Yeah. Pretty dangerous. So, all right. Well, let's move on to our last company for today, which is Warner Brothers Discovery. Their symbol is WBD. They're in the entertainment industry. This company's gone through some major turmoil over the last, I'll say, 3 years or so. Short is only 3.2%, so that's a positive. This does surprise me. Institutional ownership is only 68.4%, so about 32% of people hold this, which for this stock surprises me. No PE ratio, but that's the same as the entertainment industry. Price of sales 0.5, that's very good to the industry at 2.3. Price to book value 0.6 versus 3.1, so that's a positive, but there is no price to tangible book value because I think they have a lot of intangible assets there. Price to cash flow is good, 3.6 versus 17.3, and they do not have a PEG ratio. No earnings over the last 12 months. The industry is up 86.7% in the entertainment industry. Amazon, I mean, I don't know how they got that number there. Netflix. Oh, there we go. Thank you. Sales are down 3.1%. Industry down 0.8%. Oh, you got to love this 5-year growth rate. A negative 117.6%. The industry up 11.2%. So that would scare me quite a bit if I was going to buy this company. They do not pay a dividend. Let's take a look at the balance sheet. 0.9 is the current ratio. That is below the industry at 1.9. Debt to equity 1.2, which is okay, but the industry is at 2.5, so I'm okay with that. Net profit margin, a negative 28.8 versus the industry at a negative 1.1. And then return to equity, another bad number here, a negative 33.2 versus a positive 15.4. I don't know what you're going to see going forward, but I'm not optimistic.
Yeah, I mean, it's pretty quick. And then I got something, I guess, that we can kind of end with talking, again, about China, going back to the beginning of the show here. But current price for Warner Brothers Discovery, ticker symbol WBD, it's $7.97. The 52-week range, the low here is $6.64, and the high $12.70. So, again, I mean, it's a recurring theme here, but not surprising to see many of these stocks down, given the market kind of turmoil here. But I was going to say it's going to be a pretty quick target sell price here for Warner Brothers because, well, they have a negative estimated earnings per share of 12 cents. So they're estimated to lose 12 cents, I guess is a better way to say that. So there's no way for us to derive a target sell price based off losses instead of positive earnings. I was kind of surprised. I know listening to David Zaslav, the CEO, he always talks about the cash flow coming in and the free cash flow, but I'm not sure why, accounting-wise, it's not translating into earnings.
Yeah, and I was going to say Zaslav. David
They call him the Zaz.
Zaz. Oh, okay, we'll call him Zaz. He's got a great reputation. He's been there a few years, and he's not been able to work his magic. Now, I know he's gotten paid some pretty big money. I think he got I want to say it's a $20 million pay or something. The stock did go up, I think, a few months ago. I think it was like around 10, 11. They made some deal. Looks like it's lost all that, and I don't see. And again, it's another. Gosh, we're hitting the icon companies here. Yeah. That is one that again has a lot of good things. Name Warner Brothers.
Yeah, good name there, and the big reason we looked at this stock was it got hit hard. And I want to talk about China before we end the show here. Is they came out and they said they're actually going to restrict imports of Hollywood films due to this global trade war. So that actually pressured the stock even more. It was actually down 14% on Thursday. Now, there are some other issues, obviously, in the stock market that day. But just another example of China, I think, pushing these, I'm going to call them empty threats. They've really been pushing their own films rather than, Hollywood films, which I don't have a problem with. So I kind of see this as an empty threat. Like, we don't really use a lot of Chinese films here, so it's fine in my opinion. But just to give you the numbers, in 2019, 9 Hollywood titles generated more than $100 million at the Chinese box office. Well, in the last 5 years, only 8 American films over that whole period have generated more than $100 million. So it's not like it's a huge market for Hollywood that is in China. Just, again, another, I think, empty promise from China to try and hurt the U.S., but I just don't think they have much left to really impact us.
Not an empty promise, but a hollow threat, because, fine, go ahead. Yeah, $100 million. And when you think of, what is there, 2 billion people in China? They're just not watching American films.
I mean, I would never watch it. I don't like the foreign films, so I don't blame them for not watching our films.
Yeah, because it doesn't the voice doesn't match up to the movement of the lips, and kind of is very distracting. So I guess that's why they don't do it. But maybe technology, AI will maybe change that. But no movies and.
No movies, no buying Warner Brothers.
There we go. There's a closing bell. Thanks for listening to Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you would like to discuss in more detail your investment needs, have other investment questions, call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. That's smartinvesting2000.com. Listen to the podcast there. You can get us on the newsletter. We'll be back next week right here on the Smart Investing Show.